If you're looking into real estate, it's always the right time to buy real estate. It's not always the right time to sell real estate. Hello and welcome. My name is Gino Barber, one of the co-founders of Jake and Gino. And in this how-to video, I keep getting asked this question by members and by people in the real estate community asking, interest rates are high. Do I keep investing or do I stay on the sidelines? Let's tackle that. And more importantly, let's go into the history a little bit about what inflation is, why interest rates go up, why they go down, and understand that context. And then we'll talk about investing in this type of market cycle. I think people need to understand residential is a little bit different than commercial. The problem with residential, it's very, very sensitive to interest rates. This market cycle has been a little bit different because we have supply and demand. But typically, why do interest rates go up? Why are interest rates going up right now? They should have gone up a lot sooner, a lot slower, but they didn't. The Federal Reserve's job is to take care of inflation. That's their main focus, is inflation. Now, what is inflation? Inflation is simply an increase in the supply of money. That's all it is. You're increasing the supply of money. Now, the net result of that usually is when you put more money into the system, you get prices rising. That's the effect of inflation. Now, back in 2021 and 22, everyone was saying that inflation was transitory. They didn't think it was going to last. Well, they made a big mistake on that because when it didn't last, they had to raise interest rates quickly. I mean, within a 6-month period, interest rates had risen so dramatically high from where they were, it put a shock into the system. And when you're raising interest rates, what happens is the Federal Reserve wants to slow down the economy because borrowing costs are higher. The economy starts to slow down. When people start to slow down, there's less demand of a product. There's more supply. Technically, prices really start to adjust. How high do interest rates need to go? It really depends upon inflation. Inflation took months and months to get under control. Now it has with rents in multifamily. We're talking about multifamily specifically now. Rents were going crazy. There was a lot of demand. There was not enough supply. Now interest rates are rising. It seems as if rents are starting to stabilize. Now they've done their job. Now you get to this point where all of a sudden the economy is slowing down. And when you have an economy that we've had the last couple of years with low interest rates, well, who does that favor? Well, it favors both parties. The Republicans want low interest rates because they know that low interest rates favor asset holders, right? There's a lot of speculation. All of a sudden you have low interest rates. People are buying assets. Asset prices are going higher. But the Democrats also want low interest rates, which is interesting because when you have low interest rates, what you're doing is you're creating that gap in income between the high income and the low income. But they look at it as having that low interest rates because they want low unemployment, right? Because when there's low interest rates, the economy's chugging along. As you raise interest rates, what happens to jobs? Jobs start going bye-bye because all of a sudden you go into recession. So they don't want that pain. So what they're doing is there's short-term gain for the long-term pain because you're saying to the economy, hey, we want low unemployment, but we know this gap is going to continue to widen. Maybe they don't understand that, but anyone who has any kind of intelligence with economics will understand that you have this low interest rate environment for the amount of years that we've had. What does it bring on? It brings on rampant speculation. Anyone heard NFTs? Anyone heard Bitcoin? Well, there was such a big run up because there was so much money in the system and the cost of capital was so low that people were gambling. They were speculating. Now, as the cost of capital increases, all of a sudden opportunities start to dwindle. The economy starts to slow down. People get afraid. The demand for that asset starts to go away. There's more of a supply. Things pull back. So that's what's going on, right? That's really, really important. The economy starts to heat up now. Right now, if you're looking into real estate, it's always the right time to buy real estate. It's not always the right time to sell real estate. And some of you may be seeing that right now. As you're listing your assets, there aren't as many buyers out there. Interest rates are higher. It may be harder to sell your asset. There's something what we call in multifamily calling a retrade or a concession. 2 and 3 years ago, that was a mortal sin. You were not allowed to actually ask for retrade because there were three other buyers behind you willing to overpay. Well, as interest rates are rising, there's less buyers out there, there's less demand for the asset, and there's a little bit more negotiating going on. So for me right now in the multifamily space, we've been waiting for years to happen, to weed out the people who weren't serious, to weed out the people who didn't buy right, manage right, and finance right. That's what's really important. And as you're looking at it in the residential space and the commercial space, the numbers still need to make sense. If you're buying a deal and you're looking at your cost of capital and the deal worked at 3% because the debt was so low, and that price, let's say, was $10 for that asset. Now, your interest, cost of capital doubles. There's no way you can continue to pay $10 for that asset unless the NOI or the income has increased on that asset. But right now, what we're seeing is, interest rates a year and a half ago were 3.5%, and you're buying on a pro forma. A pro forma is basically looking at an asset, looking at a property and saying, well, this property is going to be able to perform this way in the next 12 to 18 months. Well, a lot of the brokers and a lot of investors had these rosy pro formas and they didn't pencil out. So now they're holding these assets with much higher interest rates, with net operating income, and with income that hasn't gotten to where they want it to go. So it's really, really important when you're looking at a deal, you're bringing your debt on right now, and you're looking at the income today. Does it work today? Is there opportunity to add value at this interest rate level and to go forward? Now, what's going on right now, there's sort of a dislocation in the market between sellers who have to sell and are saying, well, you told me I can get $1 million for my property a year ago. And brokers are going back to them and saying, yes, but the environment was different, let alone the financial environment with interest rates. Right now, people know that there's a change. Right now, there's a lot more distress in the market. And not only distress, if you're in multifamily, office space is having a lot of distress. You're having distress in these mixed use buildings, in the strip malls, and all of the retail. And what happens when those assets have distress, it bleeds into the debt markets. And it's harder for an investor out there to get debt. They may have to come up with more money as a down payment, so that makes their returns get lower. So then what happens is it's harder to actually go out and qualify for the debt on these assets. When debt starts pulling back, that's the circulatory engine of the economy. All of a sudden, it's harder, less people qualify. Once again, there's less buyers out there. So as interest rates rise, it's very interesting to say that people are just leaving the market because of all that euphoria. When money's cheap and things are really great, anybody can make money. But as times get more difficult and as interest rates rise, you start going into a recession, that's when you start seeing the opportunities because asset prices need to reset. You can't buy a property at the same price a year ago if your cost of capital is doubling. And what's happening is there's a lot more money on the sidelines in this last cycle as we are right now, but that money is starting to be allocated. It's starting to go away. And as that money starts to go away and these interest rates continue to stay up, sellers who have to sell have to come to what we call the come to Jesus moment and say, I'm not getting that price. How motivated am I to sell this property? I'm going to need to adjust the price. Just drive around in any residential neighborhood right now, where I am in St. Augustine, Florida. I'm seeing full rent signs. I'm seeing open houses. I'm seeing houses on the market for more than 30 and 60 days. That didn't happen even 6 months ago. It's changed so quickly. And I think if we're going to continue to stay in this high interest rate environment, there's going to be other opportunities out there. So for me, finally, to be really successful in this part of the market cycle or in any part of the market cycle, we need to focus on buy right, manage right, finance right. Know what your numbers are. Become an expert in the market, understanding where values are in your market, and understand that right now, don't be afraid to put in an offer that may seem a little bit lower than what the seller is anticipating. If you have the facts on your side, if you're looking at comparables, if you're looking at actual in-place income, if you're looking at stuff that's sold 3 months ago or 6 months ago, and you can base your numbers based on that, know your numbers, buy on your pro forma, buy on how you can add value. Don't listen to any broker or any other one out there trying to tell you where they think the property can go. Base it on yours. And also a couple other things to keep in mind in this part of the market cycle where it's different than the other ones. Insurance has been a really heavy burden on a lot of markets. Make sure that you're underwriting for your insurance where it's going to be, not where it's been historically. If you're in high air markets where there's problems with insurance, such as, for instance, Houston, Texas, or you're in parts of Florida, Understand right now what it costs per unit in that market and underwrite for it, and the property taxes. Don't go low on those expenses. Make sure you're underwriting correctly for those expenses, right? And finally, don't buy with refi in mind, saying, hey, rates right now are 6.5%, 7%. I know in 18 months or 24 months, the rates are going to go down to 4. I'm going to wait it out and refinance the property. That may work for you. It may be a good strategy, but there's risk in that. We don't know how long this interest rate environment is going to stay high. Remember, the Federal Reserve has to keep these rates high long enough to tamp down inflation, to slow the economy down. We may have high interest rates for the next 2, 3, 4, 5 years. So if you're looking to buy a property and refinance out in the next year or 18 months and say, that's my strategy, I'm not buying it with negative cash flow and hopefully I can refi into lower debt, there's risk involved in that. I would not do that. Buy the property the way it is right now with the debt that you have in place. Try to get fixed rate, long-term financing. We love community banks, 5-year terms. Credit unions are doing that now as well. If you go to agency, probably try to get a step down. It's going to be interest rates maybe a little bit higher. But remember, if the property is basically working on the interest rate environment right now where you're getting interest rates, man, when you will have the ability to refinance, can you imagine the party? But that's the icing on the cake. The deal needs to work now. And ultimately, finally, there's a lot of deals out there that you can assume the debt. If you can assume the debt on a deal and you know that you can add value and that deal has years left on that loan, that is an amazing opportunity right now. When I started in the business, loan amortization, loan assumptions, they weren't part of the game. The last 12 months, as rates are rising, you have deals that have 3.5% interest with years left of interest only. That is a lot of value in a deal. So start looking at those deals. Finally, interest rates, high, low. I don't think you base your criteria on where interest rates are. You base your criteria on buy right, creating your buy right criteria, managing the asset properly, and looking at your finance right objectives. What's the exit strategy with the deal? As we like to say at Jake and Gino, buy right, sit tight, and real people doing real deals. Thanks again, and we will see you on next week's How To. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.